Welcome to the Byte-Size Brief. Today we are putting Beyond Meat, that's BYND, completely under the microscope. Let's get into it.
Yeah, we really need to, because what is happening right now is, frankly, pretty wild.
It's totally wild. I mean, what if I told you the company that essentially, revolutionized the modern vegan burger is suddenly betting a massive chunk of its survival on sparkling fruit juice?
Right, it sounds like a joke.
It sounds completely made up. But it is the very real situation we are looking at today. And our mission for this deep dive is to figure out what happens when a market darling just has to completely reinvent itself.
And reinvent itself while its stock chart is giving everyone severe whiplash.
Oh, absolute whiplash.
Yeah.
Because if you've been watching the markets over the last few days, and today is April 24th, 2026, just for context, you've seen BYND go on this massive tear.
Completely unexpected surge, yeah.
Right. We're talking about a stock that was just languishing at a 52-week low of about 50 cents. And then out of nowhere, it surges 41% on April 20th.
Huge jump.
And then the very next day, April 21st, it jumps another 10%, hitting a high of $1.39. I mean, for retail investors looking at their screens, it felt like the rocket ship had finally been cleared for launch.
It certainly looked that way on the surface. But, when you're dealing with a move that aggressive, we're talking over 50% in just 2 trading sessions, you have to immediately ask what the underlying mechanism actually is.
Right, because it wasn't like a sudden rush of profitability.
No, not at all. This wasn't born from some miraculous earnings report. What we are looking at is classic meme stock momentum.
Yeah.
A massive wave of retail speculation and, crucially, a really severe short squeeze.
Okay, let's actually pause and unpack that mechanism for a second, because I think a lot of people see the price go up and just assume, hey, the company did something right.
Which is an easy assumption to make, sure.
But a short squeeze is an entirely different beast. You have 31% short interest on the float for BYND right now, right?
Correct. 31% of the available shares are actively being shorted.
So just to be super clear on how that works for you listening, these short sellers have essentially borrowed shares of BYND and sold them, hoping the price goes down.
Right, so they can buy them back cheaper later.
Exactly, and pocket the difference. But when the stock suddenly ticks upward instead, they start losing money fast.
Very fast. And because their potential losses are technically infinite if the stock keeps rising, you get this panic setting in.
The squeeze.
Exactly. They are literally forced to buy the stock at a loss just to return the shares they borrowed.
And that forced buying creates this, self-fulfilling prophecy.
Right. It drives the price even higher, which triggers more short sellers to panic and buy.
Which drives the price up again. It's a mechanical market reaction, right? Not a reflection of a fundamentally stronger company.
Absolutely. It's all market mechanics.
Okay, so compared to last quarter, what actually moved the needle here? Because we need to figure out if these recent product pivots and cost-cutting measures are the beginning of a legitimate turnaround, or if this is just a speculative mirage hiding a deteriorating balance sheet.
Well, if we look at the hard data from the fourth quarter of 2025, the reality behind this stock surge is it's quite grim.
Yeah, the numbers are rough.
Very rough. Revenue dropped to $61.59 million.
Which missed the Wall Street estimate, right?
Right. It missed the $63 million estimate.
Yeah.
And it's not just the top line. The bottom line is actively bleeding.
Right.
Earnings per share came in at a loss of 29 cents, which completely missed the expected loss of 12 cents by a very wide margin.
Missing both top and bottom lines is just, it's never the headline you want.
Never. But, we always need to look deeper than just EPS.
Of course. Margins.
Exactly. The margins tell the real story of operational health. Net margins are currently sitting at a devastating negative 43.98%.
Oof.
Yeah. But the number that really stands out is their trailing 12-month EBITDA.
Right. Earnings before interest, taxes, depreciation, and amortization. So basically the core operational profitability of the business before the accountants get involved.
Precisely. And looking at it over a trailing 12-month period kind of smooths out any weird seasonal hiccups.
So where does it stand?
Right now, BYND's trailing 12-month EBITDA is at a staggering negative $177.82 million.
Wow. That is a phenomenal amount of cash to just burn through.
It really is.
So basically, it's like a leaky bucket. They are bringing in less water than expected, and the holes at the bottom are getting wider.
That is a highly accurate way to visualize the cash flow situation.
Yeah.
They are burning cash at a rate that is simply not sustainable without extreme external intervention.
Which explains a lot.
Right, and the financial reality is why this recent stock price surge to $1.39 is setting off so many alarm bells for fundamental analysts.
Because the models don't support it at all.
Not even close. Despite the recent retail excitement, the consensus fair value for BYND is actually pegged at just 70 cents.
70 cents. So the models are screaming that the stock is trading at roughly double what it is actually worth based on the underlying business.
Correct. According to several valuation models, the stock is currently over 65% overvalued.
That's insane.
You have 9 major brokerages giving BYND a strong sell rating right now.
9 of them.
9, with some price targets sitting as low as 50 cents. The retail market is pricing in a massive immediate turnaround, but the data is showing a company that is still fundamentally struggling to find any path to profitability.
Which perfectly explains why management is currently throwing the steering wheel so hard to the left.
They don't have a choice.
Exactly. Because that core burger business is bleeding cash. They are essentially being forced into a radical do-or-die strategic pivot. If the current model doesn't work, you just have to build a new one.
And this pivot is easily one of the most dramatic ideological shifts we've seen in the food tech sector in recent memory.
I mean, CEO Ethan Brown recently made an announcement that honestly felt like an admission of defeat.
It really did.
The company is officially dropping the word meat from its name. They are rebranding to become BYND, the plant protein company.
Which is huge.
And Brown was incredibly blunt about it. He openly stated, quote, "It's just not the moment for plant-based meat right now."
Which is just a stunning admission from the pioneer of the entire plant-based meat category.
Right.
It's a direct acknowledgement that the consumer narrative has fundamentally shifted against their flagship product, and they can no longer fight that tide.
So they are rolling out 2 major product shifts to try and survive this. First, they're doing a nationwide rollout of a reformulated plant-based breakfast sausage.
Getting it into major retailers, right?
Yeah, places like Kroger and Sprouts Farmers Market. But the second move is the one we really need to dig into, because BYND is aggressively moving into the functional beverage space.
A massive leap from the frozen meat aisle.
It really is, but let me play devil's advocate here for a second. They just launched a product called Beyond Immerse, which is this sparkling, high-protein fruit drink.
Yeah.
And they aren't just dipping a toe in either. They signed a massive distribution agreement with Big Geyser, a major non-alcoholic beverage distributor, to put these drinks in 26,000 outlets across New York.
It's a big push.
Massive. And if you look at consumer trends, the functional beverage market is an absolute goldmine right now.
Yeah.
Think about brands like Celsius or Prime, right?
Sure, they're everywhere.
Exactly. People are constantly looking for ways to get protein without, eating a heavy meal. So if BYND already has the proprietary tech to extract high-quality plant proteins, why shouldn't they bottle it? The margins on liquids have to be better than manufacturing complex synthetic meats, right? I mean, look at how Celsius just completely took over the energy drink aisle.
Right, but what does all that actually mean for BYND investors?
Well, I think it means they have a shot at capturing a much younger, more lifestyle-oriented demographic, people who wouldn't normally buy vegan burger patties for dinner.
In theory, yes. The beverage market has a very high ceiling.
Yeah.
But we have to look at the execution and the cost of entry here.
Okay, fair.
The mechanics of the beverage industry are brutal. It is incredibly capital-intensive to break into. You're dealing with entirely different supply chains.
Right, that makes sense.
You aren't shipping frozen pucks in refrigerated trucks anymore. You're dealing with liquid weight, aluminum sourcing, and ambient temperature logistics.
Yeah, that's a good point. The sheer physical weight of shipping liquid completely changes your logistics costs.
Exactly. Plus, you are fighting for shelf space economics against massive conglomerates like PepsiCo and Coca-Cola.
Right.
And those giants will happily pay massive slotting fees to push competitors out of the convenience store coolers. BYND's core competency is food science, right? Mimicking the texture of animal proteins.
Yeah.
Does their R&D advantage actually translate to formulating a sparkling fruit drink that tastes better than the 50 other protein waters already sitting on the shelf?
That is the ultimate test. And it leads to the bigger operational question, honestly. Launching new drinks across 26,000 outlets in New York and rolling out reformulated sausages nationwide, none of that is cheap.
Not at all.
So how is a company that is burning almost $178 million in trailing EBITDA actually paying for a massive rebrand and 2 major product launches?
By taking an absolute axe to their operating costs and, crucially, completely restructuring their debt.
Okay, let's break that down.
Let's look at the operational amputations first. They are taking extreme survival measures, most notably by entirely shutting down their operations in China.
Wow.
Yeah. They're completely exiting that geography and laying off 44 workers in the process to slash about $50 million in operating expenses.
But wait, shutting down China is a massive reversal. I mean, just a few years ago, Asia was supposed to be their ultimate growth engine.
It was pitched as their most lucrative future market, yes, but the mechanics of international expansion are really unforgiving.
Right.
Building a cold chain infrastructure to distribute frozen plant-based meat in a foreign market requires massive, sustained capital investment.
Which they don't have.
Exactly.
Yeah.
When your domestic sales are plummeting and your cash reserves are drying up, you just can't afford to subsidize an international growth narrative anymore. You have to cut the limb to save the body.
Okay, so they save $50 million there. But that alone doesn't fix a balance sheet that is this distressed.
No, it doesn't. The real survival strategy, and honestly the most complex part of this story,
Yeah.
is playing out on their balance sheet.
Right, the debt swap.
Yeah. BYND recently executed a massive debt exchange. They essentially took $1.2 billion in zero-interest convertible notes that were hanging over their heads, and they swapped them for $209.7 million in new 7% secured notes.
Okay, I definitely need to push back on this because the math sounds completely insane. They convinced their debt holders to trade $1.2 billion in debt for roughly $210 million in debt.
Yes.
Why on earth would any lender agree to take a massive haircut like that?
Because the alternative was likely getting nothing at all. You have to understand the mechanics of bankruptcy here. The original $1.2 billion were unsecured notes. If BYND were to file for Chapter 11 bankruptcy tomorrow, those unsecured note holders would be right at the back of the line fighting over whatever scraps were left.
I see.
By agreeing to this swap, they are taking a much smaller amount, that $209.7 million. But these new notes are secured.
Ah, meaning they're backed by assets.
Exactly. They are backed by the company's actual physical assets. It's a calculated risk by the lenders. They'd rather have a guaranteed claim on a smaller pie than risk getting completely wiped out in bankruptcy.
Okay, that makes total sense from the lender's perspective, but hold on, how does that actually affect BYND's stock price for regular investors like me? Because getting rid of $1 billion in debt sounds like a massive win for the company.
It is a win for the company's immediate survival, absolutely. But it came at a severe cost to existing shareholders.
How so?
Well, to sweeten the deal and make that swap happen, BYND had to print 317.8 million brand new shares of stock to hand over to those debt holders.
Ah, okay, so it's less like paying off a mortgage and more like a central bank printing money to pay off the national debt.
Right.
The debt technically goes away, but the currency in your wallet loses a huge chunk of its purchasing power.
That is the perfect analogy.
Yeah.
It is the brutal mechanics of shareholder dilution. When BYND creates 317.8 million new shares out of thin air, they are drastically increasing the total supply of shares.
Yeah.
So your existing ownership stake just got massively diluted. Any future earnings the company might eventually make will now have to be divided by a vastly larger number of shares.
Which inherently makes every individual share less valuable.
Precisely.
So the retail investors who are currently cheering for this $1.39 stock surge are essentially cheering for a stock where their actual ownership percentage just got completely decimated.
That's the reality, yes.
Yeah.
Which is why fundamental analysts look at this and see a massive disconnect. The fundamental intrinsic value of each share went down due to dilution, but the market price went up due to the artificial pressure of the short squeeze. And if you want a really clear indicator of what the people actually inside the building think about this turnaround strategy, you just have to look at the SEC filings.
You mean insider trading activity?
Exactly. BYND insider Terry L. Whitteman just filed to sell roughly 30,000 shares of stock.
Oh, wow. That is telling.
It really is. While the retail crowd is out there buying the hype of the rebrand and the short squeeze, we are seeing zero insider buying during what should theoretically be the most pivotal turnaround moment in the company's history.
It's a glaring red flag, and I think it brings us back to the ultimate reality check for BYND. Look, All the financial engineering, all the debt swaps, and all the short squeezes in the world won't save this company if consumers just refuse to buy the physical product at the grocery store.
That's the bottom line.
Right. To understand if these new breakfast sausages and sparkling beverages will actually save them, we have to look at why consumers abandon the core burger product in the first place.
It represents a fascinating shift in consumer psychology. So, when BYND first launched, the primary buying driver was environmental sustainability, right? And, a stance on animal welfare.
Yes, saving the planet.
But as the product tried to transition from a niche offering to a mainstream grocery staple, the consumer conversation shifted heavily toward personal health and ingredient transparency.
And we really see the mechanics of this shift playing out vividly in the Reddit sentiment data. If you dive into the forums where vegetarians, flexitarians, and everyday shoppers hang out, the complaints are incredibly consistent right now.
What are they focusing on?
Well, first there is the simple math of the grocery bill. Consumers are complaining that paying like $7 a pound for synthetic meat just doesn't make economic sense in an era of high grocery inflation.
Especially when the price of traditional ground beef is often significantly lower.
Exactly. And people are explicitly noting that they are pivoting to cheaper, simpler alternatives. You see these long threads of people saying they are happily going back to old school Morningstar black bean burgers.
Classic.
Right. Or they're just skipping the processing entirely and making their own whole food mushroom patties at home.
Which highlights the second and arguably much more dangerous problem for BYND.
The health angle.
Right. They are fighting a massive uphill battle against the ultra-processed stigma. The narrative has shifted from this is saving the planet to this is a lab-created science experiment.
But the irony is that BYND has actually been pouring money into R&D to fix that exact problem, right?
They have. The data shows they've actively reformulated their core products to be healthier.
Right.
For example, they recently moved away from using coconut oil and switched to avocado oil.
Which is much better.
It is. That allowed them to drop the saturated fat content down to just 2 grams per serving, which is a significant, measurable health improvement over a traditional beef patty.
Yeah.
But the underlying issue is that the broader consumer narrative has already hardened against them.
Yeah, CEO Ethan Brown actually spoke directly about this. He sounded genuinely frustrated, lamenting what he called a wave of misinformation and a period of confusion.
It's tough to fight that.
It is. He essentially asked how a product made from peas, brown rice, red lentils, and avocado oil suddenly became broadly categorized by the public as toxic junk food.
It perfectly illustrates how quickly brand equity can evaporate.
Seriously.
Whether the ultra-processed label is entirely scientifically fair or not almost doesn't matter.
Right.
It is the psychological reality BYND has to operate within. Once a consumer believes a product is unnatural, it is incredibly expensive and difficult to market them out of that belief.
So if we pull all of these threads together, the final reality check on this entire situation is this. BYND's future entirely depends on a massive leap of faith from the consumer.
A huge leap.
They are asking the very same shoppers who rejected their dinner burgers to suddenly trust a plant protein company for their morning sausages and their post-workout sparkling beverages.
It is a profound pivot. And it leaves us looking at a highly volatile financial landscape.
Yeah.
You have a stock with a massive 31% short interest still hovering over it, which guarantees more violent price swings.
Absolutely.
You have an unpredictable retail crowd fighting against deeply concerning fundamentals, like burning $178 million in trailing EBITDA. And you have massive, unprecedented share dilution.
It's a lot.
When you combine all of these elements, BYND is currently acting much more like a speculative battlefield than a traditional equity investment.
It definitely feels like the fundamentals and the stock chart are living in two entirely different realities right now.
Without a doubt.
But, hearing all of this makes me wonder about something bigger. If BYND fails to make this beverage pivot work, it raises a massive question for the entire food tech industry.
Which is?
Are we simply reaching the psychological limits of how much science everyday consumers actually want on their dinner plates?
That is the existential question for the entire sector. Technology can solve the texture and the protein profile, but it cannot force a consumer to feel good about eating it.
All right, listeners, what's your take on the future of BYND? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.